Hello and welcome to Macro Matters, the economics and politics podcast series from Aberdeen Standard Investments. My name is Luke Bartholomew, and just this week I'm standing in for our usual hosts Stephanie Kelly and Paul Diggle. And today we are talking about the outlook for inflation in the US. This is an extremely important debate in economics, financial markets, and policy circles at the moment. In fact, I think it's probably a bit of a misnomer to call it a debate, in the sense that there's at least two or three quite different debates going on around this inflation topic about short-term reopening effects, longer-run impacts, and how policy sits within all of that. So I'm delighted to say that I am joined today by my colleague, James McCann, our Deputy Chief Economist, who leads on US economic coverage to help us untangle some of those debates. So hello, James, and welcome back to the podcast.
Thank you very much for having me.
Not at all. So before we start, I think it might be useful to hear a little clip from Deputy Federal Reserve Chairman Richard Clarida as he talks about his views on the inflation outlook.
On the inflation outlook, obviously, the CPI number that we got recently was a very unpleasant surprise. We and other forecasters had expected both PCE and CPI inflation to move up on reopening, but that increase certainly caught my and others' attention. Brian, I continue to believe, as my baseline case, that this will prove to be largely transitory, and I think the details of that recent report are consistent with that.
So, James, there we heard Richard Clarida talking of an unpleasant surprise in the recent inflation numbers. So maybe it would be pretty useful for our listeners if you sort of explain the details around that unpleasant surprise and sort of what it's telling us about inflation dynamics at the moment.
Yeah, absolutely. We know in terms of context, and we've spoken about it on this podcast, that there's a pretty active debate, and you flagged it a little bit there, but about the extent to which the amount of stimulus running through the US economy, combined with reopening momentum, an already pretty robust recovery, will lead to a potential overheating. So I think there's a latent sensitivity there in markets and more broadly about inflation. And that probably is not helped by a record month from the inflation side. And in April, we got headline inflation spiked to 4.2% year on year. And we got a record increase month on month in core inflation, which put the yearly rate up at 3%. So unusually high inflation, and not just something we can explain away with this is an energy price effect. We saw core inflation rise as well, which also always creates a little bit more concern when people see that core inflation basket rising, and it's not just driven by those headline effects. So, certainly more than the market had been anticipating and more than we've been anticipating. I think it was well baked in that inflation was set to rise in April. We knew that there were large base effects from April last year. And what I mean by that is the weakness in inflation as the economy shut down meant that the year-on-year comparison, just naturally, as we moved through to this April report, was going to be flattered upwards. And that was absolutely the case. But what we saw as well were one or two really, really sharp increases in some of the components, and that pushed those headline and core rates noticeably higher than had been anticipated. And I think, as you said, just really added to this debate around what's happening on the US price side and how can we explain that and what should we think about it going forwards.
Well, so to that very question, do you think there are many lessons that we can learn from that 1 month's print, or is it all sorts of weird idiosyncratic noise going on there? People talk about the extreme rise in used car prices, for example, as a result of semiconductor shortages and there being huge amount of demand that has to suddenly hit that market very quickly as rental car companies sort of stock up their fleets again. I mean, that doesn't strike me as necessarily the kind of thing that generates sustained price pressure going forward, but is there more to it than meets the eye than just some weird stuff in a few markets?
I think it's really important to highlight those effects and the volatility and some of what we would consider to be largely transitory factors that are affecting the data at the moment. I think, what you flagged in the global, not just the US, but the global vehicle sector linked to the supply chain issues around microchips is really important. If we look at the contribution from used car sales, they were up around 20% year on year, and alone used car sales added 0.8 percentage points to that annual core inflation rate. If we then think, look at a slightly different interpretation of the effect of car prices on the economy, as you mentioned, rental prices, they're up 80% year on year. That's got a smaller weight, so it only added 0.2, but already we've got around a third of the increase in the core CPI over April year on year terms, and it's all related to these two pretty small components. Altogether, they account for around 4% of the basket that US consumers typically spend on, but they've had a really outweighted size on overall inflation dynamics. So I think it's really important to highlight where we've got one or two really extreme things happening in a couple of components, and that's biased it upwards. More generally, what we've seen though too is pressure across the goods sector. So if I look at goods inflation, excluding energy prices again, because we know energy prices can be very volatile. But if I look at core goods inflation, that's running at 4.4%. Its 20-year average is 0.1%. Normally, we get very, very low inflation in the global goods sector, but this is really extraordinary. It's not as extreme as we've seen in things like used car prices, but across appliances, TVs, computers, etc., even parts of apparel. Certainly, we're seeing more heat there, and it speaks to this tightness and bottlenecks in the global goods sector more generally. And I think that's something that's maybe got a little bit more signal. If we think about coming months, it will take a little bit of time to move through that, similar to the issues with used cars and new car production linked to microchips. But it speaks to this issue that you've got a bit of a dislocation between global goods demand and global goods supply, and that's creating some pressures, which of course is natural as economies are reopening. We've had huge dislocations in activity, but I think that's maybe we can take a little bit more medium-term signal from that we might see those issues persist for a little while longer. But more fundamentally, I don't think we should read too much in terms of a long-term inflation environment from that goods misalignment. Certainly we do think that the supply side will be able to recover and adapt to that demand, and also we think that the demand might moderate or at least normalize. So it's been interesting to monitor how what's normally a very benign environment in global goods inflation has really flipped on its head. And I think an interesting question, one I might pose to yourself is, we've seen this very clearly in the goods sector as economies and the US in particular opens up. Is there a chance that this spreads more broadly? Is there a risk that actually it's not just global goods where there's tightness, but more broadly across the index?
Yeah, so as you say, I mean, a lot of this that we're seeing at the moment is very concentrated in the goods sector. That reflects the fact that as reopenings happened, it's been the case that the goods sector has been the one that's experienced the rush of demand. Services are still somewhat slower in the recovery as there's social distancing and whatever else it is, and people sort of reluctance to come back to that. And so, if demand suddenly hits the services sector, do we see exactly those same price pressures? And I suppose the first thing to say is normally we would think of the services sector as being a lot more supply elastic, so that supply turns on quicker when prices move. Ultimately, we have to remember that, in a market economy, prices are signals, their way of destroying demand that's too high and encouraging supply to be brought on. And the problem with the goods sector at the moment is we're having difficulty bringing that supply on quickly. Normally in the services sector, we can bring supply on relatively quickly, and those dynamics are less pronounced. However, I think that there are reasons to be a little bit more concerned about the services sector experiencing those same dynamics this time around. There are quite particular features of recovering from the pandemic that might speak to the fact that we could also see bottlenecks in the service sector. In particular, there does seem to be evidence that the short-run labour supply is much more constrained than you might think just by looking at the headline unemployment rate or employment to population ratio, or any other broad range of macro level indicators that we typically look at to measure the degree of slack, the labour market slack. Those all scream out that there's a lot of spare capacity there. Yet anecdotally, and also I think evidentially as well, it does seem that firms are finding it a bit harder to fill vacancies than you would expect. And that's the sense in which short-term supply is a bit lower. And I think there are several reasons why that may be. First of all, still some sort of residual concerns about going back to work in professions that involve high degrees of social contact when people perhaps haven't been fully vaccinated yet. And then second, and perhaps more controversially, but also around this idea that the unemployment insurance was expanded quite significantly as part of the COVID relief measures. And for some people, the employment insurance represents more than 100% of the salary they would otherwise be earning if they're at work. And so perhaps the combination of that, along with stimulus checks that are still in bank accounts, means that there's somewhat less of a rush to return to work than there otherwise might be. People's outside option relative to going back to work has improved. And so their reservation wage, the amount they need to be paid to do a job, has probably gone up somewhat at the margin. And so therefore you might start to see some wage pressure there and some difficulty hiring people relative to what you might otherwise have expected. So it is plausible that, as demand moves out of the goods sector and towards the services sector, we see sort of bottleneck effects fade in the goods area, but start to be recreated again in the services sector. So, I mean, I wonder, James, again, does any of that, even though that this period might be quite a long period as the economy works through these effects, does any of that fundamentally change the medium to long-term dynamics, or are these just adjustment effects that just take a little bit longer?
Again, I think these would probably be thought out as the latter, adjustment effects. I mean, we can talk more about what would make us concerned that they would be more persistent, but all things being equal at this stage, I think we should be fairly sanguine about these adjustment effects. I mean, I think you ran through a really nice summary of why we might have some blockages in the supply side of labour. An interesting anecdote here in Boston, all COVID restrictions have now been eased. Just a few days ago that came through. And obviously it means that at sports stadiums, Fenway Park are allowed back to full capacity immediately, which is a huge sort of switch and quite a short-term switch. And headlines talking about the difficulty in shifting back to full capacity because of being able to hire so many stadium workers. And I guess there's a friction thing there. It's difficult to do that quickly when policy changes quickly. But then, as you say, there might be some things which are holding up labour supply. But I think crucially, and I tend to agree with you, I think many of those factors should ease over coming months, and that should boost labour supply, be it around viral concerns as case numbers continue to decline and vaccination rates continue to rise, be it around public health restrictions as schools reopen and there's less issues around childcare, for instance, or be it around, as you say, this issue with what is the level of unemployment insurance benefit, and is that discouraging workers? We know that a number of states are bringing those federal top-ups to an end this month in June, and the latest they can run at the moment, according to legislation, is September. So we know that the reservation rate should be falling, I suppose, over coming months. So if those supply constraints were more persistent, I might be a little bit more nervous, but I think the base case should be that those supply constraints are starting to ease, and it means that while we might see pockets of friction, short-term tensions, volatility, as we try and fill Fenway Park very quickly, maybe in the next few weeks you are having to pay a little more to get concession workers, etc., into the stadium. We do think that is something that should ease as we go forward, and doesn't really change that more medium-term dynamic around how we think the inflation process should work, absent any sort of big shift in be it inflation expectations, etc., which would make something that we'd see as being transitory into something more persistent. I mean, maybe you can talk about, think about from our perspective what the things that would make that, I suppose, relatively sanguine view on the short-term dynamics in both the goods sector and the services sector. more concerning on a more medium-term to long-term horizon? What are the things that we should watch out for that would tell us that actually this could prove much more persistent than we're currently expecting?
Yeah, sure. I mean, just before I do that, I just wanted to make a quick observation that at least one bit of good news from all of this is that this will provide future economists with an extremely rich data set of natural experiments in seeing how different states' labour markets respond as sort of the unemployment insurance ends at different rates due mostly to political factors rather than underlying economics, which should make, as I say, quite a nice time series to study. So, perhaps there is some good in all of this. But in terms of your question, I think it's a very good one. I mean, in the past, we've identified what we called three necessary and sufficient conditions that we think are required to move to sort of a very different inflationary regime. And the first of those is a sustained period of excess demand. So when the economy is running well above potential. The second is a weak nominal anchor. So this is sort of what underpins people's inflation expectation and sort of gives them a sense of what's going to ensure that the currency preserves value over time. So you can think of a time where there wasn't inflation targeting regimes from central banks and we're off the gold standard. That period in the 1970s, there was a very weak nominal anchor in that sense, and that's part of the reason why inflation did get so high during that period. And then the third is the monetary policy in particular, fails to deliver on its commitments to price stability over the medium to long run. It fails to adhere to what we call the Taylor principle, this idea that you can't allow real interest rates to keep on progressively falling and therefore sort of overstimulating the economy that way. Now, I think stacked up against those three conditions, you can sort of start to paint an interesting question about the future outlook for the US economy, because it does seem to be the case that there will be a period of above trend, above potential output in the US. That was a big reason why the likes of Larry Summers and other very big name economists were quite skeptical about the full size of the stimulus package. They were worried they were going to push output well above potential. And in our forecast, as you well know, James, we see US output above its sort of pre-crisis level, above its potential level over the next couple of years due to this very strong stimulus. So in a sense, you've got one of these conditions may be met. So then what becomes crucial is monitoring how inflation expectations perform in that environment and sort of trying to find series that gives us some sense of a forward-looking view on inflation expectations. And second, getting a sense of how we think monetary policy will respond. And I suppose that sort of brings us back full circle to Clarida at the start there and where the Fed fits into this whole picture. I mean, James, do you want to give us a sense of how we see Fed monetary policy evolving around this and how the Fed itself sees this inflation dynamic that we've described?
Yeah, absolutely. I mean, I think baked into the Fed's forecast, baked into everyone's forecast, is this sense by which US growth is going to be pretty extraordinary. We will pass in pretty short order the pre-COVID peak, so the economy will be larger than it was before this crisis, and we'll go on to probably, as you set out there, so demand will run above what we would expect the US potential supply to be for a period of time. It's always difficult to estimate exactly how big that overshoot is and how much excess capacity is there, but certainly the Fed has, I think, baked into its forecasts. And we see that very clearly in what the unemployment rate does in the summary of economic projections. The Fed expects the economy to normalize and then, I suppose, to some extent, start to move a little bit tighter as we move through its forecast horizon. I think what's also, though, baked into the Fed's forecast is that we don't start to see that excess demand lead to very, very significant acceleration in US consumer price growth on that medium-term horizon. Certainly, there's a caution around how quickly inflation is rising towards the end of their forecast horizon in 2023. And I think this builds in the view, linking to your second point, first of all, the inflation expectations are very well anchored. The Phillips curve is relatively flat and also stable. So as you mentioned, you won't get a dynamic as you saw in the 1970s, where a period of high prices becomes embedded more and more in the economy as people change their expectations of future inflation, demand higher wages, etc. I think the Fed expects that to remain relatively orderly and has built in that relatively muted response between excess demand and price pressures in the economy into its forecast. And according to that, it has a policy signal at the moment, which is cautious. It's one in which it's looking through this transitory increase, talking about, as Louisa said, a transitory increase in inflation, but then thinking forward and expecting the more medium-term dynamic of price growth to be relatively well behaved, and thinking that it will achieve an overshoot in its inflation target, but will take a while to credibly achieve that. Its latest summary of economic projections, the median dot, not thinking that the conditions are in place for a hike before the end of 2023. So, absolutely, the Fed is taking a cautious stance on that. Now, that doesn't mean that if inflation surprises, that the Fed will not shift that. I think it would take more than a period of high prices during reopening. I think the Fed would need to see some evidence of a more sustainable and more troubling increase in inflation to change its policy. But to your point around those necessary conditions to see sustained higher inflation, it does not seem to be the case that the Fed would sit back and stand idly by if we were to see sustained high levels of inflationary pressure, and it couldn't be explained away by transitory frictions around reopening an economy following a COVID shutdown. In that case, I think the timetable for Fed tightening, be it through QE asset purchases, interest rate hikes, would naturally move forward. So we still think that despite the Fed shift to an average inflation target, despite its different way of looking at how it targets inflation and meets that inflation target, it's still absolutely not willing to allow a very high period of inflation to set in the US economy. And we should expect there to be a natural ceiling on what price growth should do based on that reaction function, which I still think is very credible.
Yeah, I think that's absolutely right. I mean, the nature of an inflation targeting regime is that you shouldn't be especially worried about economic price pressure overheating showing up in inflation. The point is that the central bank will do, broadly speaking, whatever it takes to contain the inflationary pressures. It just might have to put up interest rates or tighten monetary policy quite significantly to do it. So if you're worried about an overheating, don't worry about inflation so much. Worry about what it means for the structure of rates. And I suppose sort of maybe just one final thought, if I can, from you, James. I guess a lot of that discussion there was based around the sort of lift-off and the timing of the Fed's first move to tighten policy. And whilst that is certainly an interesting debate and a lot turns on it, there is also sort of another debate about what the path of policy looks like after liftoff. And it seems to me one of the logical consequences of the Fed's average inflation targeting regime is that if you allow for a period of above target inflation, then at some point you do need a period of interest rates being a bit higher than normal, right? To sort of to put that inflation pressure back down again. So maybe the thing, if you're really worried about overheating, is less about the timing of the first hike and more about how high interest rates ultimately end up going. So I don't know if you just have sort of any final thoughts about how high interest rates could possibly rise in this cycle, whether anything that we've seen should make us fundamentally reassess ours. And I think sort of the widespread perception that equilibrium normal interest rates are extremely low and going to stay that way.
Yeah, I think it's a nice shift in focus. It's often the case that these threshold dates are seen as so important. So much focus in the market now on when tapering is announced, when, let's face it, given the size of the Fed's balance sheet, a few months here and there on tapering and a difference in the flow of asset purchases makes very little different stance to the overall little difference to the overall stance of monetary policy. And similarly, a few months aside, in terms of the date of liftoff of the Fed funds rate is not huge. I think what is important is where that terminal rate potentially is that the Fed is shooting for, how long it takes to get to that terminal rate. And absolutely, almost, what the Fed is committing to do now is maybe falling behind the curve, maybe a bit too strong, maybe, but it's certainly waiting longer it's seeing the whites of the eyes of inflation. So this sense by which it might need to, having waited to tighten policy, adjust policy a little bit more quickly, I think probably does have a lot of merit. And then, we can build in, often we think about interest rates in nominal terms. We should also think about the real aspect of things. And if inflation is sustainably higher, the Fed's hitting its target and achieving an overshoot, then that would argue for a little bit of a higher peak nominal rate potentially in the US. And the equilibrium rate is one that's difficult to nail down, but perhaps there's some argument that if the Fed is successful in raising inflation expectations back to target, then that could make us more confident that real interest rate may rise a little if some of the Biden infrastructure investment style initiatives are able to raise the predictive capacity of the US economy a little. That could be helpful. Maybe more generally, lower levels of government saving is another thing that could drift this higher. So maybe there's some chance as well that the US economy is able to live with a slightly higher nominal rate, and that peak of interest rate is higher. But an interesting dynamic is, how will the rest of the global economy cope with this? I think that will be an interesting spillover effect. We know that during the last cycle, when the US had a lot of stimulus through the Trump tax cuts, interest rate hikes in the US caused a great deal of disruption in emerging markets, in global financial markets, and they washed back quite quickly into the US. So, that's almost the potential sting in the tail could be, is there a risk that the US has dislocated or will dislocate to a significant extent, and that will create its own stress in global markets as it tries to exit its policy settings?
Well, I think that is an excellent note to leave it on. So thank you so much, James, for joining us today. I really appreciate all your insights there. We have a mailbox, Macro Matters, all one word, at abrdnstandard.com, and we would love to hear from you. If you have any questions, topics, thoughts or feedback, please do email us on that address there, macromatters@abrdnstandard.com. Don't forget to like, subscribe on your preferred podcast platform. We're on Apple Podcasts, Spotify, SoundCloud, Google Podcasts, and Buzzsprout. And with that, thank you so much for listening, and speak to you again soon.
Please note that email is not a secure form of communication, so don't send any personal or sensitive information. This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for information purposes only and should not be considered as an offer, investment recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen Standard Investments. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns. Return projections are estimates and provide no guarantee of future results.